Greg, welcome to the show.
Yeah, thanks, Brandon, for having me on the show. Looking forward to spending time together today.
Let's start with how you got started in real estate.
Yeah, so myself personally, I grew up in a family that owned some commercial real estate. They owned a lot of, hotel properties. They owned a business that actually did a lot of lending to hotel, owners. So personally, grew up around the business, both on the credit or debt side as well as the equity side across hotels, as well as my family owned a lot of other just commercial real estate property types. And that started really with my grandfather, and my mom worked for my grandfather. And then I worked every summer for the family business growing up, so I was cheap labor. And then went to school at University of Texas at Austin. And when I graduated Texas, I went into banking, where I specialized in capitalizing and financing primarily hotel projects, back when I was on the banking side. So finance capitalized over 300 hotel projects before starting Peachtree in 2007. So that was really from a personal perspective, grew up around the business, and then professionally, obviously, spent time in and around the commercial real estate space, focused primarily on hotels before starting Peachtree.
So it sounds like real estate's in your blood. Was it, as you were a kid growing up? By the way, where did you grow up?
Yes, I grew up right outside of Tuscaloosa, Alabama. It was a very small town, and my family, had my grandfather actually originally had moved to this town, so I grew up, in that this town called Fayette, Alabama, which is about 50 minutes from Tuscaloosa, and so it was a great place to live, but it was a great place to start out just because my family owned a lot of the real estate in that town and around the state of Alabama as well too.
So growing up in near Tuscaloosa, was it obvious to you that the thing that you were going to do as an adult was get into the real estate business, or how did you balance this family history with real estate and your own kind of personal career ambitions?
Yeah, so it's interesting. So originally, my grandfather he was a doctor by trade. He was an eye doctor, and so he didn't want me to go into real estate. Really didn't want me to go into business in general. His belief, because he grew up back during the Great Depression, and so he was a big believer in getting a master's in something, and thought I should be a doctor. And so he was very much he was very passionate that he thought I should go become a doctor, and then once you become a medical doctor, then you can become entrepreneurial and start businesses and get into real estate. And so originally I was focused when I went to college, to University of Texas. I was focused on being a doctor. So I was a biology major of all things, and so it was a little bit I came through. So although I grew up around the business, I never really thought I was going to end up being in a situation where I owned hotel properties or owned a business that helped capitalize and finance commercial real estate assets, as well as, focusing on buying and developing hotels and so forth. So it's sort of interesting that I ended up here, and it's almost by accident that I did end up here. But it's worked out really well.
So you study biology. At what point did you make the transition from, the medical doctor path that your grandfather wanted you to be on to, whether it's banking or real estate? Was that something that you knew kind of after you enrolled in biology, it wasn't right for you, or you had a different plan, or did that happen kind of more by happenstance later?
Yeah, so it happened really. So junior year of college, I think I started coming to the realization, because at the time, at this point in time, I was 20 years old, and I was working because I had a job in addition to going to school at University of Texas at Austin. And I just realized I really was getting burned out going down the track of biology and medicine, and it just wasn't what I wanted the rest of my life to be. My grandfather wasn't totally sold that was the smartest decision, and he's been a huge influence in my life. He was very much I had a lot of respect for him. And he was somebody that I really, modeled myself after. So, out of respect for him, I wanted to try to become a doctor, but also I started realizing that wasn't my true passion. And so, as junior year sort of unfolded, I started looking at the possibility, if I did, ended up not going to medical school, was there a path to go down the road of business? And at the time I did have, one thing, I left out is, although I was working, I also had a couple of different, I call them side hustles, different businesses that I was, running myself. and thought, one of those businesses could be the path to, being able just to not, end up going to medical school. And so as I transitioned into my senior year, it became very evident that if I was going to not go down the medical school route, I was going to have to find a full-time job. And that's when I started, looking at different opportunities. And this goes back to, 1999. And, back in 1999, if you lived in Austin, Texas, and you were, a student at University of Texas at Austin, the big opportunities were, going to work for like Arthur Andersen in Houston, which fortunately I didn't go down that path because we know how that ended. Enron was another one as well. And so, fortunately, I didn't go down either of those paths, nor did I have the background or experience or even the education to get opportunities with them. So I was looking at different opportunities, and fortunately, I had a relationship with somebody that was running one of the divisions at General Motors at the time that did hospitality finance. And I was able to get an opportunity to go interview there, and ended up getting my first job out of school, at GMAC Commercial Mortgage within their hotel finance group. And that was my first, entree from a professional perspective into commercial real estate.
Out of curiosity, what were the side hustles?
Yeah, so it was a couple of different things. One is, I had a business that actually we sold pagers. So we actually, myself and I had a partner at the time, and we went out and we bought a bunch of pagers. We bought paging lines from PageNet back. Again, this is back in like 1997 and 1998, back when pagers still existed. So, which is sort of interesting because I talk to my children about it today, and they don't even know what a pager is. But it was something that was part of our life back in the 90s and so forth. But I had a business that did that. I had a business that was focused on the internet at the time, which the internet was relatively new back in 1997, and had created a company that was a portal to the web for college students. And it was something that was focused primarily at the time, was focused at University of Texas and some other schools, and had some success with that business, and thought it was something we could scale up. Unfortunately, myself and my partners ended up deciding after several years of having that business, we ended up going different directions, but we did make a little bit of money off it. So they were, each of these side hustles, were successful in their own right, but they weren't going to be, successful enough to get me to the next place I wanted to be.
That journey during college brought you to GMAC, and you're doing hospitality finance. But before we get into kind of the pure real estate background in Peachtree, I'm curious, you grew up in a real estate family. What were some of the experiences? Like, what did you think about real estate as a kid? Was it just something that you were always around? You mentioned you were cheap labor. Are there any jobs that you were doing during the summer that kind of stand out to you now as a hotel, owner and kind of hospitality real estate professional?
Yeah. So it's funny, like every summer, like I spent so much time like stuffing envelopes, for, basically sending out, again, my family owned a business that did a lot of lending. So they would send out the monthly invoices, and I would have to stuff the envelopes with the invoices and help put the stamps on them. So I did a lot of things like that as a child. I used to travel with my mom. She would go to different hotel properties that we owned. She would go to different hotel properties that we were looking to finance. We owned, laundromats back in Alabama as well too. So I used to go to those to collect the actual, money, the quarters and so forth out of the machines. So it was a lot of, I would say the lessons I learned is just, and it's hard to say it's lessons. It probably just helped build that discipline and knowing that you have to, constantly be involved in the business. You got to constantly, make sure you stick to a schedule, take care, be proactive to take care of stuff before, issues arise. You have to, deal with, managing individuals and managing teams, and being able to understand and sort of see that. Because, as a child, I wasn't necessarily doing all that or setting it, but I was watching, if it was my grandfather or my mom, being able to observe and watch them as they were running, their business. It was a really good education for me, and it allowed to, really set that foundation. And so I think it gave me that initial discipline to, to take the next steps in my career. both, from an academic perspective. When I was in college, I did very well from an educational perspective, even though I shifted. But also, since graduating college, I've always, lived a very disciplined life and a very disciplined schedule. I'm a big believer in that, and that's what helps promote success.
Fascinating. So after GMAC finance, is that when you started Peachtree, or was there something in between?
Yeah, so started Peachtree, actually, so GMAC got a little bit complicated in the sense our group at GMAC, was there from 1999 till 2005. I was part of that group, and unfortunately, at the end of 2004, GMAC Commercial Mortgage had gone through this whole entire reorganization, and they ended up, dividing up parts of the business, and part of the business was recapitalized. Our part of the business, our division of GMAC Commercial Mortgage, was sold off to another organization called the Bankers Bank at the time that became known as Silverton Bank. It was a correspondent bank that effectively was owned at this point in time back in 2005. It was owned by, I believe, around 300 community banks, and it served as an entity that would go out and we would originate loans that we would turn around and syndicate, participate out to all these, community banks. In some cases, some of these smaller regional banks as well would buy into these participations, which was huge, obviously, back before the great financial crisis. They also offered, other services like bank card services and back office services for these smaller community banks to allow them to initially scale up before bringing those operations in house. And so I had worked at the Bankers Bank, which became known as Silverton Bank, running the hotel origination desk for several years before starting Peachtree. And that was really, from the assets, or from the sale of our division at GMAC to Bankers Bank.
Interesting. And how did that experience at what point did you decide you wanted to leave the bank and go out on your own? How did that experience inform your starting of Peachtree?
Yeah, so it was, really going back to, I would say around 2004, 2005. And this is where I met, my partner, Matul, and, Jutin, or, my two other partners in the business in Peachtree. And I believe, Jutin Desai. You may or may not have met, Matul Patel, but, Jutin and Matul were both really good friends before we started Peachtree. The three of us were, good friends. And I had met both of them, at different times. I had met Matul in the late 90s, back when I first moved to Atlanta and first graduated from college, and we became, really good personal friends. But around 2004, 2005 time period, Matul and I would always talk about, wanting to go out and buy some hotels together, or even develop hotels from the ground up. And so we were constantly looking at looking at potential opportunities to partner together. And finally, we found two assets to buy together in May of 2007. So I was still, working on the banking side at this point in time, but we found our first two assets, to buy together. And that's when we started Peachtree. So I always say we picked the perfect time because we were at the peak before the great financial crisis. And from, May of 2007 till, call it, first quarter 2008, we went out and bought several more hotels. And we even, we ended up buying a bunch of land parcels to develop new hotels. And so we were very, very vested and really invested into the lodging and the hotel space before the great financial crisis. And so fortunately, it has worked out, and it actually worked out really well in those investments we made. But there was, clearly there was a lot of challenges in 2009, 2010 we had to deal with.
Where were the first two assets that you bought?
Yeah, they were in Pell City, Alabama. So we bought our first two assets, which Pell City is about 30 minutes outside of Birmingham, Alabama, on Interstate 20 between, Atlanta and Birmingham. So it's, clearly closer to Birmingham, but those were the first two assets we bought. It was a Hampton Inn, Holiday Inn Express. And we actually ended up doing well in those assets. We carried them through the great financial crisis and still delivered, ultimately delivered, like around a 170 equity multiple in our investments and around a 10% return when we sold those assets, back around 2013, 2014 time period.
I would have to imagine, though, 2007, 2008, Lehman collapses, the GFC hits. you weren't feeling, I mean, I don't want to put words in your mouth, but how were you feeling? I can't imagine, you were riding cloud nine at that moment, having just started your own business, or did you see this as an opportunity and, you knew you were going to get through it. You just needed to trudge along.
Yeah, so it's funny how everyone sees things differently, right? Like at that time period, like in 2007, obviously in the fourth quarter of 2007, you probably recall the CMBS market really pulled back, and it was the first signs that we were probably the first warning signs, at least, were there that we're probably heading to something larger. And on the banking side, at this point in time, our business was exploding because pretty much all the non-traditional lenders, all the institutional lenders were pulling out of the market, and regional banks, community banks were all benefiting. The national banks started pulling back, from a lending perspective, but our business, at this point in time, that Silverton was exploding. So we were doing really well in the fourth quarter of 2007, as well as even in the first half of 2008. But it was around the first half of 2008, I realized, because you could start seeing in the data, the performance of hotels were starting to pull back, meaningfully. And we started seeing that pullback. And that's when I realized that, because when we started Peachtree, it was really more of a personal investment vehicle for myself, for Matul, Jutton. We viewed it as more of a small family office. And we didn't view it as we're going to be this private equity shop, but we really thought it was going to be a vehicle for us to personally invest, along with like my family members and along with Matul and Jutton's family members. And then we quickly realized in 2008, in the first half of 2008, that we're going to have to play defense across all these investments that we just made. And simultaneously, there's going to be a huge opportunity set that's going to come out of this in some format. We didn't know if it was going to be able to go out and buy, debt per se. We didn't know if it was going to be able to buy assets on the cheap, but we figured there's going to be some opportunity set there. So that's when we really took a step back and said, okay, let's reevaluate the business. And we made the decision to internalize the operation side of the business, where we took back because at this point in time, we were using third-party operators to run the hotels that we owned. So we had about 8 hotels in the mid part of 2008, and we took back the operations. And then we also, set up our own development company to handle, any of the projects that were under construction. And that's when we internalized both the development and operation side of our business. And then we quickly shifted. So those 2 businesses allowed us to play defense on our investments. And then we shifted from a standpoint of being able to go out and make new investments and be able to play offense. And we started focusing on going out and buying, at the end of 2008, really going in the first half of 2009, we shifted and started buying, focusing on buying distressed debt. And we bought a bunch of distressed debt in 2010, 2011 from regional banks, community banks, from the FDIC and so forth, where we bought a lot of discounted loans secured by hotel assets, by non-hotel commercial real estate assets like busted subdivisions, and really took advantage of that trade, back during the great financial crisis.
I think what you said is fascinating about, bringing the asset management back in-house. We'll talk about, some of the investing that you did during the downturn of the GFC, but what was it that, sparked you to realize that you needed to bring the asset management and kind of everything in-house at a time when, the external world seemed to be unraveling very quickly?
Yeah, it was basically just watching the performance really turn negative very quickly, during the great financial crisis, because it was no different than during the pandemic. The difference being during the pandemic, you went from record occupancy to zero occupancy overnight. During the great financial crisis, you just constantly started seeing performance decrease. And at this point in time, we were using third-party operators to run the hotels that we owned. And the challenge there was these operators were under a lot of, they were distracted because they had challenges across their whole entire portfolio of assets. And in a lot of cases, they owned their own assets as well. So their attention quickly flowed to their own assets, trying to save those assets. And we just didn't feel like we were getting the appropriate attention. And that's when we made the decision, let's just internalize the operation. And we have, because we had debt against all these hotel assets that we owned. And in many cases, we had personal recourse. So we knew we had to be able to play defense and wanted to be very proactive in managing and asset managing our investments. And the best way to do it is to control the operations. And that's why we established our own property management company. We still even have it today. Although we've grown our platform substantially through the years, we still have our own operation platform today to be able to effectively play defense, because you don't make a lot of money operating hotels. You make most of your money, on the investment side, when you go to sell the assets, from the cash flows on your investments and so forth.
And at this time, I think you mentioned it was set up originally as a family office. So did you have any outside investors, friends and family or otherwise, or was it really just your own, family you had? But did you have that fiduciary responsibility to other investors that you did not personally know?
No. So it was all really, primarily just family members, or we had a couple of close friends that would invest with us, back during this 2007, 8, 9, even in 2010 time period. So we were truly very close to being what a lot of people, qualify as a family office today. We were truly initially set up as that, where it was just, our capital along with these family members. Now, from a fiduciary perspective, it's really hard to go to Thanksgiving dinners if you're not performing on your investments. And so it was much harder to actually, to be a fiduciary to your parents and to your, like my grandfather and my grandmother, and have to deliver bad news. So we worked probably 20 times harder to make sure we delivered. And even today, my family still, along with my partners, our families all still invest in everything we sponsor.
Fascinating. So you started to talk a little bit about the broken deals that you saw, and was it at that point that you started branching out of, just hospitality? I think you mentioned a broken subdivision deal. What did that chapter, kind of call it, 2008 through, the balance of the GFC / the exiting that period look like for Peachtree?
Sure. So, Peachtree in its early stages there's no question, was very focused to, investing in branded hotel properties that were limited and select service or extended stay hotels, under the Marriott, Hilton, Intercontinental Hotel Group flags or franchises. But we also in 2009, 10, and 11 started making these non-hotel investments where we were buying, primarily we'd buy these larger pool of loans. And this is where the non-hotel exposure started coming, because banks, these regional banks and community banks, would be like, look, I'll sell you this hotel first mortgage loan, but I'm only going to sell it to you if you buy some of these other loans that are non-performing from us. And so they would, force us to buy, in some cases like a busted subdivision, where it would be a bunch of empty lots that were, planned for future, housing developments. In other cases, it would be like maybe a retail, like a small retail type strip center, or even, we bought, debt against like, some, small office buildings and things like that during the great financial crisis as well. But the majority of what we did buy was hotel loans. But that's when we did start making our first non-hotel investments, was during the great financial crisis as a firm. But it was all on the credit side. And we actually delivered really good returns, actually, even in some cases, even better returns than what we've received on the hotel side, buying these busted subdivisions and buying some of these non-hotel loans during the great financial crisis. So we did really well across all the investments we made during that time period.
And at what point did you transition to kind of an investment, from the quote unquote family office to an investment management business? What did that look like?
Yeah, so it's interesting. So it was around 2010. We obviously became very opportunistic, took advantage of the great financial crisis as we talked about in 2009, 2010. It was in 2012 we realized, okay, well, the ability to buy loans didn't exist anymore, and we were buying hotel assets, and we were still developing hotel assets from the ground up in 2012 and even in 2011. But we saw, at this point in time, that there was an opportunity set to go out and do direct lending. And so we shifted our, debt buying business to doing direct lending to groups that needed first mortgage loans to go out and refinance or acquire new hotel assets as well as other commercial real estate assets. And so we started to realize in 2012 our business was more than just being a call it a family office, or even being, because a lot of times we go to conferences in 2012 and 2013 and people would be like, okay, well, they would view us as an owner of hotels. In some cases, they would say, well, you're an operator of hotels, because we were operating, call it around 2013, probably around 20 assets or so. Other cases, people would say, well, you're a developer, because I see you're developing, hotels in different parts of the country. And our response would be, well, we're really, yeah, we do that. We're really not a developer or just an owner or just an operator or even just a, lender. We're more than that. And that's in 2014, we went through this transition where we really reorganized the business and said, okay, what are we as an organization? And we were always finding inefficiencies in the marketplace to make new investments. So we're always finding, where's the best use of capital to drive the best, outsized returns or outcomes to the investments we're making. And we quickly realized, that we're really a private equity shop. And that's when we made that transition into being, if you want to call it an investment platform or a private equity shop, that's when we made the transition and said, okay, we're a vertically integrated private equity firm that's investing primarily into hotels, but we're making investments outside of hotels as well across commercial real estate. And we made that leap in 2014. And, and when we say vertically integrated, obviously having the ability to operate, develop, lend, asset manage, all these different businesses that we've, had back in 2014, as well as other businesses we've created since then, as part of our vertical integration, and really allows us to drive and optimize those investments that we're making across the platform.
I think that's a great segue. Let's talk about what is Peachtree today. Give us the the headline numbers in terms of size and scale, and talk to us about the business lines that you're in. Give us an overview of what 2024 Peachtree looks like.
Yeah, so Peachtree's grown, as I mentioned, tremendously through the years, and as you look in 2024, today we have over $2.5 billion of equity under management across about $5 billion of assets, and so we're heavily invested, as we've talked about, across the hotel space, but we also have investments across pretty much all commercial real estate property types. As an organization, we own, we have other investment strategies too outside of real estate. For instance, we own a business that does a lot of film finance. So we're slowly becoming a bigger lender into the film space, where we finance, directors and producers to create new films, where we're leveraging the different distribution rights that are being sold across the world, and that's how we're financing those producers to make those films. So we're doing other things, and that's just one example. But we're doing a lot of other things that are either within or even outside of commercial real estate, beyond just as we've talked about, doing just direct lending or owning and operating real estate. So we've continued to just grow across the platform, and as we sit here today, we've made over 700 investments since 2007. So we've always been very active on making new investments, and we've exited out of over half those investments. So we're still, today we have over 300 investments that we're still servicing across the platform. And, we currently operate about 90 hotels across the US, and we have well over 200, first mortgage loans that we're servicing, as well as we own a business that does a lot of commercial property assessed clean energy loans, or CPACE loans. We're one of the largest originators in that space. And we have a huge book there, as well as, as I mentioned, the film finance business and some other businesses.
Out of curiosity, you mentioned you see yourself as a private equity firm. You didn't say a real estate private equity firm. And then we talked about film finance. Is it, when we're thinking about kind of putting people into buckets, is it right to think that you see yourself more as a private equity firm that does real estate and other private equity type investments? Or how do you think about the positioning of Peachtree given the breadth of your portfolio?
Yeah. So, I mean, hands down, majority of our assets under management are real estate, driven, if it's on the credit or equity side. But as a firm, the reason I don't see us as just a real estate private equity firm is the fact that as an organization at our core, we're looking for inefficiencies in the marketplace that we can take advantage of to drive outsized returns relative to the risk that we're taking. So it just happens to be real estate historically is what we're focused on, but we've made a lot of money, making investments outside of real estate where we find some type of inefficiency. If it's like using the film finance, example as one, where we find that, inefficiency in the marketplace where we can drive really good returns relative to the risk that we're taking, we'll make investments, into that space. And, C-PACE lending is sort of, I would say, although it's real estate, theoretically, it's real estate backed, you're really putting, these property taxes on the assets. It's a little bit different. It's more of an asset backed type strategy. Or an asset backed investment type strategy. So it's just an inefficient space where, we're able to drive really good returns relative to the risk that we're taking across those assets when you look at how we're making those investments, how we're capitalizing those investments, and the risks we're taking to get, the ultimate returns we're making.
So I want to come back to C-PACE and to hospitality. We could talk about film as well because I think it's fascinating. But 700 investments since 2007 is a tremendous volume. Talk to us a little bit about, what does the team look like? How big is the company in terms of, kind of the corporate staff? Obviously, you're going to have a lot more, in your assets, I'm sure, at the hotel level. And then, how are these deals traditionally capitalized? Are you raising money deal by deal, or do you have a fund series? Like, how does that work from a organizational perspective?
Sure. So, from an organizational perspective, we have, close to 300 corporate team members. So we have, a pretty large corporate bench, across the organization that are, set up to go out and, identify investment opportunities, to underwrite, asset manage, service, operate, development, and so forth. And then, out in the field at the different hotels that we operate, we have, an even larger team out there. We've got, called over 3,000 team members across the different hotels that we operate. So we have a large organization, from that perspective. And it's, so it's something that, we're set up very well from that perspective. And then what was the other question? Just take.
So how do you capitalize your transactions? Do you do this in a fund series, or do you do it on a deal by deal basis, or a combination?
Yeah. So when we look at our, investments, or how we make our investments, the majority of the investments are made through a fund series. So usually, we have a fund strategy where we're going to go, find an investment strategy that we feel is very scalable, and we'll make those investments out of funds. And, in many cases, what we've done is we'll go in and we'll really incubate an idea, meaning we'll go in and corporately we'll make a lot of the initial investments, like when we did the C-PACE business, even the film finance business, because those are two businesses that we've launched in recent years. And we'll incubate those businesses corporately. And once it gets to a scale where we feel like we can go raise a fund around that strategy, and we feel like it's scalable enough, then we'll launch, a fund that will, focus on that strategy. So that's typically how we capitalize our investments. And then we have a lot of these, that ends up happening across our fund vehicles. We end up having a lot of, different co-investments that we end up doing in order to manage risk across individual investments. And so because we tend to be from a portfolio management perspective, we tend to try to, control how much exposure we have to, to any individual investment across these different funds. And so, like in the last year and a half, we probably have done, call it 15 to 20 different co-investments outside of our funds to help, and these are investments that were made through our flagship funds, but to help manage risk and so forth.
So do you seed the funds? And when you say you start it from a corporate perspective, you're making loans, you're buying assets, whatever it may be, and then are those kind of seeded vehicles? Is that how it would typically work? So an investor can see the first few deals that might be in the fund?
In some cases, we have seeded some of the funds. In most cases, we have a pipeline that's very robust. And so, for instance, we'll go from, one credit fund to the next credit fund, because we've done 4 different credit focused funds. And, in each of those cases, as we go from one series to the next, usually we'll have a pipeline of opportunities. And although they're not closed in that fund, investors that are looking to invest will be able to see that opportunity set, and they're able to, make, or at least they're able to have some visibility. And there's usually allocation policies between those vehicles and so forth.
Understood. And then, last question on kind of capitalization. Are your investors traditionally, institutional investors or non-institutional? What does that look like?
Yeah, so we have a wide range of different groups and individuals that invest with us. So we do have high net worth, super high net worth family offices, registered investment advisors, endowments and pension funds that all allocate capital into the different vehicles that we sponsor.
All right. Well, let's talk a minute about a few of the different strategies before we get into the macro. So you mentioned CPACE. For our listeners who aren't familiar, and you talked a little bit about how it's more of an asset-backed strategy. Can you describe kind of the 101 or 201 CPACE and kind of why is it so attractive as a strategy for you all?
Yeah, so I think it's great for developers, owners of commercial real estate as well, because a lot of people are using retroactive CPACE to help recapitalize assets where someone just recently opened up projects today, as well as if you're developing a new project, it's a great source of capital as well. And then for us as a owner of the business that does CPACE loans, what happens is effectively we're going out and making investments that are call it 20 to 30%, in some cases a little bit higher, but 20 to 30% of the underlying total value of these assets that are typically new projects, although they can in some cases be renovation projects. But the majority of what we do across the CPACE business is we help capitalize and finance new construction projects. And in many cases, we can sort of mirror this project with we'll have our CPACE loan, and then we can do a construction loan on top of it. And it's just a better execution for the borrower because the CPACE loans, especially in today's environment where interest rates have risen very quickly, in a lot of cases, you're able to get fixed rate debt that's around, call it, 8%, in some cases less, or some cases a little bit more on the CPACE side. And it's a pretty attractive, rate just given market conditions today. So.
In CPACE is the legislation, or PACE financing is the legislation around, energy efficiency in new buildings, right?
Yeah. So it's exactly, it's all about energy efficiency. So it's for projects that are, more energy efficient, which, if you're building a new project today, it's very likely your project would qualify. And if you have a new project that opened up recently, it's another it's a great program as a source of liquidity, which a lot of banks will allow. And we've done a lot of these projects recently where a project's opened up recently. Someone developed maybe it's a multifamily project, a hotel project. It could be an industrial, whatever the project is. But assume it's $100 million project. Will come in and provide a $20 to $30 million loan because the existing bank may have a $70 million loan on the project. The borrower put in $30 million of equity. The project opened up, and the bank, which may be a regional banks looking to deleverage their exposure, the borrower may not have underwritten, interest costs being as high as it is today. And so they're looking for, some level of liquidity for interest reserves as they ramp up the property. So we can come in and in many cases, we'll provide like a $20 million loan that will pay down the existing senior loan and then provide some liquidity for interest reserves going forward. So like assuming we made a $20 million loan on this hypothetical $100 million project, we may pay down that $70 million senior loan, assuming they had 70% financing, down to $55 million. And then we'd turn around and as part of that $20 million loan, we'll give them $5 million of like an interest reserve account to pay interest on the senior loan and to help, cover, interest costs on the CPACE loan and things like that as well.
Fascinating. And are you, I think you said you're one of the largest originators of CPACE. Is that, who else is in that market? I'm not looking for like firm names, but, are these kind of non-bank financial institutions, lenders that are most active in the market?
Yeah, it's pretty much all non-bank, non-bank lenders, mostly institutional groups, private equity shops like us are in and around this trade. I think there's a lot of interest from a standpoint of other private equity shops, other, lenders trying to get into this business. There's several trying to get into it right now. It's just very challenging because, we have the benefit. We were an early adopter to this program. We, learned the business going back years ago, and we've really done a great job building out our are not only the network of potential borrowers and relationships with different brokers and borrowers and so forth, but we really understand how the program works in the different states, because it does vary by states, and we have a team internally that does a great job going out and originating and underwriting and servicing. So we feel like we have a huge advantage to the marketplace, given we've been focused on it, but also given the fact that we're diversified internally from a standpoint of doing all this lending on the construction side and doing acquisition loans. So we see all these different projects, have all these relationships with owners of real estate. We have relationships with banks, and we've helped banks, help them deleverage without even taking losses on their books to, sell off loans through CPACE lending as well. So it's been a great program for us. It's great for the counterparties that are involved. If it's a bank that's got the senior loan, it's great for the borrowers and sponsors to allow them to have capital to manage through all this volatility that's in the marketplace today.
Fascinating. Let's move to the hospitality side. You've been very active in the lending space for many years. What are you kind of currently focused on as it relates to hospitality in particular?
Yeah, so hospitality, we're focused primarily on going out and developing hotels, as well as acquiring hotels where there's a value add strategy. We do buy some stabilized hotels because we do have a DST strategy where we aggregate 1031 money into these DST structures in order to buy stabilized hotel assets. And under that strategy, we're just paying all cash through 1031 money. But outside of that program, primarily if we're buying hotel assets, we're buying assets that have more of a value add strategy where we're coming in and leveraging our operation platform. We're able to leverage our renovation team and construction team to go in and complete renovations to allow that property to be more competitive with its comp set. We're implementing brand changes in many cases that are accretive to the investment and so forth, to create those values on the acquisition side. And then on the flip side, development to us is super compelling today because there's not a lot of groups able to develop, because it's very hard to get not only construction financing, but it's hard to raise the equity needed to do development, because most lenders that are lending to development today are doing no more than 50 to 60% leverage. And so it's very hard for most developers to come up with 40 to 50% equity. And that's led to, within the hotel space, as well as some of the other property types, because you're seeing the development pipelines start to drop off, especially as you go out over the next couple of years. And part of the reason, the development pipeline within hotels have dropped off is because of that capital markets or the credit markets dislocation. But then also hotels, during the pandemic, any new development project was put on the shelf because no one was traveling, and there was concerns about the viability of the lodging business back in 2020. So those two factors have created the perfect storm for the hotel business, in the sense that supply is growing at a call it a 30 to 40% reduction to historic averages. So supply is only growing at about 1% a year. Historically, supply grows at about 1.6% a year. And then demand, there's just huge tailwinds to the growth of demand in travel. And demand's growing, above 2% a year today, and it's expected to continue to grow over 2% a year for the next 5 years on average. And so demand's way outpacing supply. And there's a lot of just submarkets that lack hotels to support the demand in those markets. And the one thing that we've found within our business, within the hotel business, is that new always wins. And so if you can build new product today, you're going to, when you open up, you should have strong, underlying performance at the asset level. And then you also have, just from a standpoint of buyers, most of the, public REITs, if it's sovereign wealth funds, larger institutions, larger private equity shops, they're all looking to buy new hotels, and those tend to trade extremely, well when you're in a normalized environment. So we find developing hotels, to be very interesting in this environment for those reasons.
I spend a lot of my time with institutional investors and allocators, and for whatever reason, hospitality, despite all of the phenomenal metrics that you just shared, tends to be a laggard or tends to be at the bottom of the list of things that people are interested in. I am seeing that change a little bit. But why do you think that is? Why do you think, or maybe you don't see it that way? Maybe that's just my perspective, but I guess I could reframe the question to say, is this a institutional quality asset class? And if it is, how do you expect the asset class to continue to evolve given the current environment that we're in?
Yeah. I mean, hotels have always been challenged, right? And most larger institutions and a lot of the institutional investors, as you mentioned, are very weary to invest, across lodging. And even smaller investors in many cases are weary to invest in lodging because you've had mixed results through the years. Because, when times are good, all hotels do well. When the market pulls back, that's where, unfortunately, a lot of investors have lost a lot of money within the lodging space. I do think, hotels, I would say, this time around, when you look at what's happened with hotels, and there's a couple of different factors too. I think sometimes people end up saying hotels, mean all hotels, but all hotels aren't equal in the sense that you've got like large full service hotels, you've got limited and select service and extended stay hotels that we primarily invest into. You've got budget hotels. So you have all these, the hotel space is pretty vast of, different property types. And there's no question the luxury hotels, the large full service hotels carry a ton of risk and they're always subject to, economic conditions. The one thing we've found and the reason we stay invested across select service and extended stay and limited service hotels, because they tend to have less volatility in that space. So I think it works better for institutional investors, that select service, limited service, extended stay space. And then the other factor I think that's just happened within lodging is and it makes it lodging today probably more interesting than what historically for institutions is. You look at the cap rates that hotels trade at, like the cap rates for hotels are still pretty much at historic averages, right? Like hotels are trading at, call it 7 to 9% cap rates today for the type of hotels being the limited select, extended stay, premium branded hotels. And that's where they've traded for the last 15, 20 years in that range, depending on locations, the age of the asset and brand and so forth. Whereas you look at like multifamily, during the pandemic, I mean, the cap rates there just compressed to this unsustainable level. And you've seen this recalibration in cap rates over the last, 18 months where, the cap rates within multifamily have started to expand out because the 10-year treasury rate has, it's doubled from where it was over the last 12 years. And so I think most institutions are starting to look harder at hotels because they are starting to realize there's more reprice, although, multifamily, industrial, make a lot of sense. There's just more repricing risk in those assets as those cap rates continue to normalize back out to historic levels. And hotels have less repricing risk, not to mention you have like a record amount of supply getting delivered in multifamily versus hotels is totally the opposite. So hotels have, I would say probably more interest today from institutional groups wanting to learn more because they see that opportunity set. And then the final factor is just the under allocation of capital to hotel stake. The dry powder on the sidelines that's been raised over the last several years, only call it 4% of that capital is allocated to hotels. Yet hotels make up 7% of the commercial real estate ecosystem versus like multifamily today, makes up 35% of the commercial real estate ecosystem, yet over 50% of the dry powder is allocated to multifamily. So to me, there's not as much opportunity, there's not as much inefficiency in that marketplace in multifamily to find opportunities versus hotels where there's an underallocation of capital relative to its size. And I think you can find more opportunities today within hospitality and you have less of the negative leverage issues if you're a lender. That's why you're starting to see more lenders look at the hotel space today as well, given the fact that hotels trade at higher cap rates and ultimately lead to higher debt yields versus some of these other property types.
That's fascinating. The 4% the 4% statistic is fascinating. I mean, correct me if I'm wrong. What percentage of select service hotels in North America or in the United States are institutionally owned? I would have to imagine it's a pretty small percentage. There's a lot of family businesses and non-institutional capital sources that kind of take up the long tail here. I'm guessing, but you probably know better than I do.
Yeah, it's, I don't have an exact percentage, but if I had to sort of guess off the cuff, I mean, I would say probably, you know, 30, call it 30% of the limited select service hotels are owned by, institutions, right? And the other 70% are, owned by mom and pop type operators or regional groups. And so there's a lot of inefficiencies between those groups and how they operate. And that's a huge opportunity set, just take advantage of as an investor.
So if I'm an institutional investor, if I'm an investor that's been, neutral to bearish on hotels historically, but I'm interested in getting back into the space, what are the two or three questions that I should be asking either myself or groups like yours to better understand like how to, let's assume we're starting at 0 or 1 on a scale of 1 to 10. How do we kind of build up our knowledge? What are you hearing from smart investors who are really interested in digging into the space right now?
Yeah, I mean, it's a tough question to answer because it just varies based on the actual strategy. But if you're new to the hotel space, I think it's more understanding what's the experience of that sponsor, how they've executed through cycles and have they been successful managing through like a great financial crisis, a pandemic, what's their track record and being able to manage through those, cycles. Why do they want to go buy, like their strategies on buying assets? Are they putting the right vehicles together? Because, buying a stabilized hotel works well for like a public REIT. Does it work as well for a, private equity, shop or a private equity type fund? Probably not. Because, when you buy stabilized assets, there's not a lot of upside usually in those investments and you're just, buying cash flow. And that's why it works well for a DST strategy. It works well for a public REIT and so forth. Versus buying, if you're going to go buy an asset with a value add strategy, is it well thought out from a branding perspective, what brands you're choosing, or even if you're developing hotels, understanding the different brands? Because where I see people lose a lot of money in our space is they end up either investing in a project where someone's developing a hotel in a submarket and they're partnering with a hotel developer that has good intentions, but they just choose the wrong brand for that location or the wrong product type because you're building a transient hotel in a market where you should be building extended stay hotels, or you're picking a brand that's gonna, that historically is underperformed, for what it is. And you could had picked a better brand that's going to drive better performance. And so you just have to be thoughtful in that regard, or you're building an independent hotel. And I've seen this many times where someone wants to be the hometown hero and build the Taj Mahal. And it's more of I call it an ROE play for them, where it's return on ego versus I always tell everyone we're focused on IRR, whereas a lot of other groups are focused on ROE, that return on ego, and we're focused on actually deriving cash flows and actual returns on the back end as well.
I'm personally fascinated in this space. I find I could talk to you for hours and ask you questions about every brand, but we don't have hours to do that. So I'll save that for another time. But one thing that is on my mind, you've been very public about, commenting on the macro economy. Rates are going to be higher for longer, not just specific to hospitality. It's a two-part question. Curious to know your outlook on rates in general and what that means for private credit, a business that you're very active in. And it's not lost on me that, you kind of started your career with Silverton at a similar point in time. So maybe there's some parallels that you can share. So I think that's one is like rates in private credit. And then I want to make sure that we hit on the health of the consumer. I've had conversations with you and Jutton in the past, and I think you have a really interesting perspective given that you are in the select service hotel space on what's happening from a consumer perspective. And I want to make sure we hear those. So you could take the questions in either order, but let's talk about both.
Yeah. So I think hands down private credit, like we've talked a lot about the equity side of hotels and so forth. If you're going to invest in commercial real estate, investing in hotels, I mean, I think there's opportunity sets on the equity side, but it's more rifle shooting. There's not a macro trade in equity in hotels or in some of these other property types. I think hotels, there may be more of a macro trade just because of some of the things we talked about earlier with the under allocation of capital. But even then, I think the best opportunity is to invest through private credit right now, because you can go out and finance groups to acquire assets, to develop assets, to recapitalize assets, where you're financing 60 to 70% of the acquisition costs, the values of these underlying assets. and you're getting returns that are very similar to what it would be if you were investing through the equity side. And that's really a function of just, there's not as much debt capital in the marketplace from traditional sources like regional banks, community banks, and you're able to drive higher spreads. Not to mention the index rates are much higher, and that's what's allowing for that opportunity set to exist today. So it's very compelling to be on the private credit side. And I think if you take just a step back, I think interest rates are going to be I think interest rates obviously have risen dramatically over the last 20 months or so. But I think interest rates are going to stay higher. I think a lot of people expected rates to drop in the first half of this year. I think it's very, my personal opinion is, I think I'm not expecting rates to drop much more than maybe 2 times to 3 times this year. I would not be surprised if rates didn't even drop this year, just looking at the strength of the public markets. And that's helping, the consumer stay healthy as well. And the job market has continued to remain healthy, although you've seen some layoffs, but people are continuing to be employed. People that want opportunities are able to find opportunities. Unlike during the GFC, we didn't have the gig economy. It wasn't as prevalent as it is today with Uber. Being able to really find other ways to complement your income to support your lifestyle. We didn't have those opportunities back pre or even during the GFC. So this is it's created just a totally different economy. It's created a consumer that's from my perspective more resilient than what we've experienced. Not to mention, as I talked about the public markets, we haven't seen that pull back to a level to really pull down the ability for consumers to spend money. So maybe that changes later this year, and maybe that's the impetus to rates dropping substantially higher than I'm expecting. But even if rates drop, ultimately, I don't expect the 10-year treasury rate to drop significantly from where we are today. The 10-year treasury rate, over the last 12 years has averaged around 2%, around 2.2%, I believe. Today we're at 4.3%, call it. And I think when you look over the next 5 years, I think we've basically entered an environment where the 10-year is probably going to average around 4%, maybe a little bit higher, maybe a little bit less, but it's not going to be at 2%. So we're going to be double. And if that's the case, I think there's just going to continue to be really challenging as the market's trying to recalibrate and absorb these higher rates on the equity trade side. It's going to be very hard to find, really good opportunities to drive these great returns that we've seen that have existed over the last, 12, 15 years through cap rate compression. The returns were driven through cap rate compression. When you're in an environment where cap rates are going to continue just to expand out as risk premium spreads continue to recalibrate to historic ranges, which hasn't happened across like multifamily, for instance. They're still compressed by a good probably 7,500 basis points from historic averages. So I think as you just look at the marketplace, it's just very challenging to invest in equity in commercial real estate. On the flip side, the debt side feels really good because you're in at a basis that I would argue is protected with downside protection, and you're getting return profiles that are very similar to the equity side.
So if there's a sponsor listening who has a project that needs financing, are there any asset classes that you're not active in right now, or are you looking across all of commercial real estate? What should people make sure that they're flagging to Peachtree?
We're looking at everything. Office is without question the toughest property type for us to finance. We have done some office investments, not a lot on the office side, but we will make loans on office on a selective basis. But I would tell you, just with all the secular distress in office, most of the stuff we've seen in office is just way too challenged. And that's why we haven't bought a lot of loans secured by office assets. That's why we haven't made a lot of direct loans in that space. But by far, we're making loans across pretty much all commercial real estate property types. We're very active within hotels, multifamily, industrial. We're doing a lot of horizontal, land development across, these different developers that are building out, subdivisions and lots to sell off to the public home builders and builder-rent groups. So we're active, pretty much across most property types, and even including retail. We've been very active in financing groups that are acquiring malls as well as other retail parcels and so forth.
Fascinating. I just want to finish up on the consumer again. You touched on the resilience of the consumer and the the strength of the public markets. And we're recording this, at the end of February of 2024 for context. Yet, we've heard the R word, the recession word come up a bunch. We hear statistics about, credit card debt, yet the consumer is still spending like it's 1999. I was out to dinner last night in a suburban part of San Diego at 8 o'clock, and the restaurant was packed. And I said, who are these people? Who's eating out? We were celebrating something special, but it seems like you see the same thing in your hotels, right? And we're seeing it across many parts of the economy. What is it like? What's your viewpoint through the lens of your, either your lending business or your hospitality business that's going on with the consumer right now that's driving travel and discretionary, or maybe in some cases in your world, non-discretionary spending? But like, how would you describe that situation to us?
Yeah, it's hard to figure out exactly what's happening, but I think, from my perspective, I think there's just been a shift in mentality. Like consumers, they're not necessarily, like, given the higher interest rates, they're not selling homes, they're not moving as frequently as they were over the last, decade. And now all of a sudden they've shifted, and they really, coming out of the pandemic, they value the experiences. They value going out to restaurants and spending time with friends. They value being able to travel and going to see family members and go visit with customers and so forth, if it's corporate travel. And so I just think there's more money being allocated to the experience side of their balance sheets. And most consumers today are making more money than they were, pre-pandemic. I mean, let's just face reality. Everyone's making more money. There's been inflation. We've been in an inflationary environment, and everyone likes to talk about inflation's coming down, and inflation is coming down, but we're not in a deflationary environment. We're in a disinflationary environment. So it means inflation is still growing. And so we still have, positive inflation. And I think it's going to be really hard. Everyone has a different opinion on where inflation is going to settle. And again, if we end up, settling below 2%, then we probably went through a hard landing to get there, is my gut take. I think, the Fed's going to, struggle to get it all the way down to 2% without having a pretty, substantial economic recession. And it doesn't feel like that's going to be the case based on what's happening in the public markets, nor what we're seeing just happening across the labor markets and so forth.
Yeah, well, I think only time will tell in this particular situation. Well, Greg, I think we're just about out of time today, but if any of our listeners want to get in touch with you or a member of the Peachtree team, learn more, figure out, how you might be able to finance one of their projects, or interested in investing in one of your vehicles, what's the best way for people to learn more about Peachtree and get in contact?
Yeah, definitely feel free to reach out to myself or, anyone on our team. Please visit our website, at peachtreegroup.com, as well as, you can email me or call me. I believe my contact information is on our website, but, feel free to reach out, or you can reach out to Brandon, and Brandon can put you directly in touch with me. So that'd be great.
Easy. Well, Greg, thanks so much. As always, I've enjoyed the conversation. I appreciate you sharing your insights today.
Yeah, thank you. I appreciate it.